Hello everyone, today we are diving into something super exciting for first time home buyers, which is FHSA or First Home Savings Account. This could be a game changer for many of you, so let's get right into it. Before I begin the topic, let me make a disclosure here. I'm not a financial advisor, so consult your financial advisor before making any financial decisions. So, those who don't know me, my name is Cash, a real estate agent and investor based in Brantford, Ontario. I'm here to help first-time home buyers and investors. So, let's see how FHSA can accelerate your purchase of first home in Canada. So, what is FHSA? FHSA is a registered savings account, just like RRSP, TFSA, RESP. FHSA combines the best of RRSP and TFSA to make your first home a reality. So, let me explain you in simple language how RRSP and TFSA works. So, in an RRSP account, you get a tax deferral, meaning let's say you earned 65,000 this year and contributed 5,000 into RRSP. Your income tax will be calculated based on 60,000 annual income. So, if you are employed, you might have already paid tax for $65,000. So when you file your taxes, you will get a tax refund based on your annual income and your contribution. But there is a catch. When you withdraw funds from RRSP, it's taxable. Homebuyer plan allows you to withdraw money from RRSP tax-free to buy or build your first home in Canada. You can withdraw up to 35,000 as a person, and as a couple you can withdraw up to 70,000 tax-free money to purchase your first home in Canada. Home buyers withdrawing funds do not have to pay income tax on the amount withdrawn as long as the funds are repaid into RSP in the future. There is a 15-year repayment period which will begin in the second calendar year following the calendar year in which the withdrawal is made. This is how RSP contributions helps you to buy your first home in Canada. Now, let me explain you what is TFSA. Tax-free savings account is a registered savings plan that lets you save, grow and withdraw money tax-free, making it a great option when saving for short-term and long-term goals. One of the greatest features of TFSA is the flexibility of when you can withdraw your money and tax-free growth. Unlike RSP, you are free to withdraw funds from TFSA anytime, but there is a government mandated limit how much you can contribute to TFSA every year. So an FHSA brings best of both RSP and TFSA. An FHSA is a tax-free first home savings account designed to help Canadians save for their first home purchase. This account combines many benefits of RSP and TFSA. It has the tax deduction part from RSP and the tax-free growth portion from TFSA. And you do not have to pay back the funds withdrawn from FHSA. Overall, these accounts mean to help Canadians to save their first 40,000 towards their first home purchase in Canada. Eligible Canadians can contribute up to 8,000 per year, and unused contributions can be carried forward. Before you open an FHSA, you should make sure you are eligible for the tax benefit that it offers. To be eligible to open an FHSA, you must meet the following requirements. Number one, be a resident of Canada. Number two, be at least 18 years of old but not older than 71 years. Number three, be a first-time homebuyer as defined by CRA. There is a lifetime contribution of 40,000 and an yearly contribution limit of 8,000 per person. If you are a couple, you can contribute up to $16,000 a year. You can carry forward up to 8,000 of your unused annual contribution amount to use it for a later year. For example, if you open an FHSA in 2023 and contribute 5,000, you can contribute up to 11,000 in 2024. Carry forward amounts do not start accumulating until after opening an FHSA. Qualifying withdrawals to buy a home are tax-free. To qualify, a withdrawal needs to meet certain conditions set by CRA. Question. Here is one common question. Can I use both FHSA and homebuyer plan? Yes, you can use both FHSA and homebuyer plan for the same home purchase. Homebuyer plan is where you withdraw money from RRSP and pay back in 15 years, where FHSA, you do not need to pay back. There is a 15-year rule in FHSA. If you didn't buy a home in 15 years, you can move your FHSA money into an RRSP without tax penalties. This doesn't reduce your RRSP contribution room. Remember, you have to be a resident in Canada from the withdrawal until you buy your home. The home must be located in Canada. In summary, FHSA is a fantastic tool for Canadians to save for their first home. You can combine FHSA with homebuyer plan for greater flexibility. And let's say your plan changes and you are not planning to buy a home in Canada. In that case, you can transfer your FHSA into your RSP without any tax penalties. And this is gonna boost your retirement savings. Enjoyed the video, right? Like, share, and subscribe for similar valuable contents. If you got any questions or thoughts, drop the comment below. That's all about today's videos. If you haven't seen my latest video, click the link here. Until next video, signing off, Cash.